Financial modeling is absolutely critical for profitable scaling. Not because financial modeling will directly influence and affect the growth of your business, but because financial modeling will help you to make better decisions. If you make better decisions, then you will be able to conserve your critical resources. You all have two resources in business: money and people. Cash and team, okay? It will allow you to conserve your critical resources. And if you've got more critical resources, then you will be able to seize opportunity at the right time, often at a time when your competitors are weak because they have not looked after their critical resources. It allows you to project risks and model into the future and see how different situations, how different scenarios will pan out. Project, not predict. You have to do the predicting. And the quality of any modeling is based on the quality of your assumptions, but it will allow you to take those assumptions, take those predictions, and project them into the future and model what different scenarios will look like, and that's what we're going to be talking about today. I'm going to start with a personal story. At the start of 2020, I was starting to see some jitters in the supply chain. To give that some context, I import goods from China. So I was definitely seeing some supply chain jitters at the start of 2020, but I was also seeing some issues on the customer side as well. And we were watching this very carefully, of course, as you would expect. Fast forward a few weeks to the end of January, it was definitely getting worse. This was not looking like a hiccup. This was looking like possibly a big issue. And my models told me that I would go broke by April if it got as bad as I thought it would get and not better. In the first days of February, I made a big decision. I decided to cut my expenses by 80%. I'm shivering, my hairs on end, recalling it now. I decided to cut my expenses by 80%. By the end of February, I had exited a 5,000 square foot warehouse and offices. I had moved my stock to a contract fulfillment warehouse. I had sold thousands of pounds of equipment and furniture. I had put one engineer and a screwdriver in a shed so that somebody could keep doing some repairs, and I'd moved just a few select staff to working from home, and the job was done. At the time, while all of this chaos was going on, other people that I was associated with, business people particularly, thought I was crazy. They didn't really know what I was doing. That was helpful because I was selling some of them my furniture and my equipment. Fast forward a couple of months later, they wondered if I had a crystal ball. Now, you all know that that's not true. What I had was the confidence to make a massive decision and to make it quickly. And it was financial modeling that allowed me to do that. Now, the rest of 2020 was a rough year, no mistaking that. Certainly, I was bruised, and at the time, my ego had taken a hit. I really thought I'd let the side down. I had a business that was a fraction of its former size. But in retrospect, I realized that it was the biggest and most important decision of my life. I wouldn't be here to tell the tale had I not have made that move. And in fact, I still didn't make a loss in 2020. We were a lot smaller, but we were alive, and we had kept our critical resources, our key people, and importantly, we had retained a lot of cash that we went into 2020 with rather than burning through it. So that in 2021, we had our most profitable year ever. And the reason that we had the most profitable year ever in 2021 was only because we had kept our powder dry, because we had those critical resources that we had preserved. And we were able to seize an opportunity that required a lot of free cash flow. We'd preserved our cash. If we had limped into 2021, we wouldn't have now been able to do it. If we had made those cuts a few months later, we wouldn't have been able to do it. Even if we'd have waited till lockdown started on the 23rd of March 2020, who doesn't remember that date? If we'd have waited that long, we would not have made it. And that's the context that I want to begin with, to give you a sense of why it's important to do modeling. Now, as leaders, as founders, as CEOs, you have two critical things that you need to be focused on in your business. The first is operations. You've got to run efficient operations. It's pretty obvious. It's what you're going to get sucked into and drawn into every day. And in fact, EOS is a system for running your operations. There are other systems out there. I'm not going to talk to that today. EOS is a fantastic system. It will enable you to run better operations. But you have one other critical job as a CEO, and that is capital deployment. It is absolutely critical that you have a system and that you're very clear about how you are deploying your cash or conserving your cash that those operations generate. If you're not looking after cash, eventually the operations have a massive risk. If we took two companies, two identical companies in an identical industry, same business model, same revenues, but those two companies had a different CEO, and one CEO was focused solely on growing the revenue, but the other CEO was focused on cash flow and prioritized free cash flow above all else, those two businesses would end up in two very different places. And the reason is that revenue is not what will build lasting value in your business. Revenue is, of course, something that we're all focused about, right? So everybody knows their revenue number. Everybody knows what it was last year. You've got a goal for it next year. You talk to other people about revenue. Everybody wants to grow their revenue. You think and dream in your head every night, if this, then that, maybe I'll get more revenue. But it is cash flow, and only cash flow, that will build lasting value in your business. And if you look back through history books and study this, and if you look at the most effective CEOs in history, and none of those, by the way, are Jack Welch, then all of those CEOs focused on free cash flow above all else. And they had very modest offices. And you haven't heard of those businesses. They focused on free cash flow. It is the difference between a wildly successful business and just an average one. Companies that are built on strong free cash flow are not just profitable, but they're also resilient. And because they have free cash flow, they're able to seize opportunities when they arise, often at a discount because everybody else hasn't got the money and they haven't got the resources. They're able to make strategic acquisitions, again, often below market value because they're buying when everybody else is selling. They're able to pay dividends to shareholders. Yay, that's what we all want. But importantly, when times are tough, when the market turns into a bit of a storm, they're able to pivot their businesses when necessary. They have the confidence to do that, and they're able to survive a downturn without a panic. I can't claim that I survived 2020 without panic, but I did survive 2020. And that's really the critical lesson to take away from this. It's the ability to survive. Now look, as CEOs, as leaders, we all have pretty much the same tools when it comes to decisions around how we're going to deploy our capital. There are only 4 ways that you can deploy capital. You can either reinvest it into your business, put it straight back into your business and reinvest and grow and put it back into operations. You can use it to acquire other businesses. You can use it to issue dividends, and I'm sure that's something that we're all very keen to do. And of course, you can, and at some point may have to pay down your debt. That's the only 4 ways that you can actually deploy your capital. And we're all in that same situation, but we will make decisions differently. This is about effective decision making. And on the flip side, how do we get money into our business? There's only 3 ways as well. Either we generate it from those internal operations, so internal cash flow generation. We take on debt, which will of course come with the liability to repay that plus interest, or we give up equity and then potentially some control in order to get funds into the business. So the simple and obvious and most effective recipe for most of us, especially a small and medium-sized business, is to rinse and repeat the top row, is to generate cash from our internal operations, reinvest it to operations, and so the loop goes. Now, that's not to say that you should never take on debt or never give up equity. There are absolutely situations where that will apply. I've got one slide at the end of today about funding. But we're going to focus on cash flow as a primary focus today. And if you can generate cash flow from your internal operations because they're efficient, then that is a much better business than one that is giving up equity or taking on debt. And of course, in good years, you can issue dividends. And when there's strategically, there's alignment and the time is right and you want to acquire another business and you've got the cash flow for that, then fantastic. But the main focus is generating cash flow from your operations and putting it back into operations to fuel your growth. What you have to realize, and what I realized in 2020, is that you cannot control your revenue. There's only one thing you can control. What can you control? Costs, expenses. You can only control your expenses. In 2020, I had a revenue problem. And there was no telling me otherwise. There was no changing the market. Obviously, it was extreme conditions, but I had a revenue problem. The only place I could exert control in 2020 was on my expenses, and I took radical and rapid action. I want you to stop obsessing over revenue. I want you to put your focus where you can exert your control on expenses and obsess. And I do mean that word specifically. I want you to obsess over cash flow. Cash flow is what will build lasting value in your business. So today we're going to run through two things. We're going to first of all look at cash flow mastery. We're going to take you through how to model cash flow. This is your number one resource. Remember, you have two resources in your business, money and people. And so the second thing we're going to look at today is labor efficiency, because labor efficiency is all about how you utilize your biggest expense. And I guarantee it will be the biggest expense for everybody in this room after cost of sales, after the gross profit line. It will be your biggest expense and your biggest resource, absolutely. And so we're going to look at the efficiency of your labor, because we want to model that as well as we scale, as we grow our business. Your business is like a train. The objective is not to build the longest train. The objective is to get to the destination the fastest and using the least fuel. Your fuel are your resources, it's your cash, it's your people. If you focus on building the longest train and you burn up your resources, then you risk running out of track. If I hadn't have made the decisions I made in 2020, I would have run out of track. And that's terminal. So we're going to dive into cash flow. You will all recognize this simple formula. I don't need to persuade any of you that profit does not equal cash. But what I've discovered when doing workshops is that people frequently struggle to tell me why profit doesn't equal cash. I made the money, didn't I? Why isn't it in my bank account? So I'm going to do a quick 101. We're all at different levels, and I'm going to move quickly, and we'll get into the harder stuff as well, so don't worry. But first of all, let's look at some of the differences between profit and cash. First of all, timing. So we record profit at the time that we deliver the product or service. Okay, so that's what we're actually obliged legally to do. However, cash, of course, is recorded when the money comes into the bank or leaves the bank. That's the simple first thing. Lots of different things are included in profit that aren't included in cash. So we include depreciation. We pay for assets out of our cash, but we depreciate them, and that goes against our profit and loss. When we get debt, then that debt, we access debt. Guess what? You borrow £1 million, £1 million arrives in your bank, doesn't get recorded on the profit and loss, but the interest on that debt does. Same with taxes. It's two-sided. Sales tax don't go on your profit and loss, but it's money that comes into your bank. It's like a little free float for 3 months. But your business taxes, of course, come off your profit and loss. Prepayments will appear in cash. Most people, particularly small businesses, don't record prepayments. They don't keep a track of how much, if you receive money up front from your customers, or if you have to pay up front your suppliers, then these are prepayments. These are movements in your cash balances that could impact you in a very positive or very negative way. And some other things we see on the profit and loss would be write-offs, for example, when we eventually dispose of our assets. What we're measuring when we're talking about profit is we're measuring business efficiency. We're measuring how well the performance of the business, how much performance we're achieving. But with cash, we're measuring liquidity. It's showing us our financial health, and importantly, it's showing you your ability to invest in future growth. And that's what we're going to be able to measure with cash flow as we get into this. Where do we measure these? You don't need me to tell you that. Hopefully, if that's before 101, if you don't know where to go and access that information. Okay, so we've got three primary measures of cash flow that we're going to go through today: operating cash flow, free cash flow, and net cash flow. There's a lot of information on that slide, so you can take a picture, and I'm happy to share my slides afterwards. We'll start with operating cash flow, because operating cash flow tells us at a snapshot, and this is very important if you're purchasing a business, how much cash a business can generate. And we have to go to both the profit and loss and the balance sheet in order to get those numbers. I'm going to take you through step by step exactly how we do that. So we'll show you how to do that. Free cash flow is the most used measure in publicly traded companies, because free cash flow takes our operating cash flow figure and takes away any capital expenditures that we've made, any investments that we've made that aren't going to be reflected in this period of time on the profit and loss. And it shows us how much money we have to invest in future growth, which is why it is the singular most important focus for a growing business. And net cash flow, as the name implies, tells us all movements of cash. Cash inflows, cash outflows, shows us exactly how much cash has been brought into the business or how much cash a business has burned. And if you're carrying debt, it's incredibly important to measure net cash flow, because sometimes your bank balance may be staying level, but in fact you've taken on debt and you've burned through money, and you have to be able to make a decision whether that was a good use of debt or not. And there is no jury on this. You have to decide. It is not always good or bad to take debt, but you have to be able to figure that out. I will show you how to figure that out today. So we're going to start with a simple profit and loss. You should all have, or they're dotted around the room, a set of financial numbers. You don't have to be looking at these as we go through, but the numbers that I have on the slides are reflected here on the piece of paper, because that's the one thing that you're probably going to be thinking about when you go to bed tonight. So you've got the numbers. So we've got a hypothetical company. I think I've called it Sumco or something on the sheet, but let's give this company a name. Give me the character trait of your best friend, Ed.
Joyful.
Joyful. Charlotte, could you give me the last thing you bought on Amazon?
A Crucial Conversations book.
A book. Okay. So we will call this company Joyful Books. I'm so glad it was a book. Okay. had some very bad accidents with asking people their last item they bought. So we've got a simple profit and loss here. You can generally interpret these numbers. You're all smart people. We've got revenue all the way down to the net profit at the bottom. What do you think of Joyful Books? Give me your analysis, your interpretation, your first comments, your thoughts. Somebody tell me, what do you think of Joyful Books? Other than the fact they've sold a lot of books. Yes, please. Healthy gross margins, fantastic. What else do we see?
Revenue's up 25%.
Revenue's up 25%. Yep, there's a numbers man.
A lot of extra debt.
There's a lot of extra debt.
Or interest rates have dropped.
Okay, so debt interest has increased, so we're wondering where that has come from. Very insightful, I like that. Anybody else? Okay, let's look at it. So things are generally rosy. Revenue is up 25%. Exactly right. Gross profit's up even more, 33%. This is a business that is definitely focused on profit. Operating profit also up 33%. But you all know that we should be looking at the balance sheet as well. You've already got that in front of you, but let's bring the balance sheet up on the screen. I'll make it ever so slightly easier for those of you that don't look at a balance sheet too regularly. I'll split it between assets and liabilities. Assets are what you own. Liabilities are what you owe. There are some curious caveats to that, because some of the things you own aren't yours or in your bank account, but we'll come to that in a moment. So I have a simple question, and the formula was on the previous slide, so you've all recorded it mentally in your mind. What is the net cash flow of Joyful Books? Can anybody tell me what the net cash flow is of Joyful Books? Abby?
100,000.
100,000, okay. Gentleman at the back?
Sorry.
Okay, so we've got 100,000 net cash flow of Joyful Books. I'm not saying at this point whether you are correct or not. Any other guesses or calculations on net cash flow of Joyful Books? You're all entrepreneurs. You can look at a business quickly, make an evaluation, decide if you want to buy this company. You coming in with an answer? Sorry, 2.8 million. Positive, negative? 2.8 million positive. And Abby, I'm guessing yours was 100,000 positive, because we're looking at the top line. Okay, net cash flow is a measure of all flows of cash in and out of the business. How do we measure that? Let's take a look. The total cash movement will need to come from three places on this balance sheet. First of all, the move in our bank account. And on most of your balance sheets, that'll be several bank accounts and credit card accounts and overdrafts and all that sort of stuff. Your very short-term kind of funding. But we've summarized it here as cash at bank. But as you rightly spotted from the debt interest, there has been a shift in our short-term debt and our long-term debt positions. Net cash is a measure of all cash flows in and out of the business. If you start a business at zero and borrow £1 million and they put that in your bank, you now owe £1 million. The net cash flow is zero. Yes, I know you've got £1 million. It's also not yours. The net cash flow would be zero in that scenario. So we'll take the numbers from this business. We have that positive movement of 100,000 that the gentleman here saw. We've got an increase in short-term debt of 2 million and a long-term debt increase of $500,000. The net cash flow is sadly not 2.8 million positive. It is 2.4 million negative. Joyful Books has burned 2.4 million in cash. But the question that we have to ask ourselves is, was that good or not? You bought one book, it was good. We have to figure out whether this was good debt or bad debt. So the first thing that we need to do in our journey, it's not the next cash flow measure, but in order to figure out our operating cash flow, we need to take profit and loss figures and also figure out what our working capital was, which is the amount of money that a business needs to trade. And we're going to take that from 3 different places on our balance sheet. The cash needed to trade will come from our accounts receivable, our stock, and our accounts payable. Now, thankfully, this is a stock business. We have books, so we definitely have stock. Some of you will have stock, not all of you, but some of you will have stock. So if you have stock, inventory, if you have work in progress, that's also recorded on a balance sheet in exactly the same way. It's an asset, it's work that you've put time and resource in, but haven't yet invoiced. Work in progress is technically the same on a balance sheet as stock. And then we've got our accounts receivable. We generally call that debtors in the UK. That's where I say it's an asset, we own it. It's your money, but it's in somebody else's bank account. And our accounts payable is the opposite. It's somebody else's money that's in our bank account. It's suppliers that we haven't yet paid. So we need to sum these up, and we can do that here quickly. So we have a £3 million shift in our accounts receivable. Accounts receivable has gone up by 3 million. Our stock has increased by 2 million, and our accounts payable has decreased by a small amount, 200,000. Netting that up, then we have a 4.8 million increase in working capital. Again, you do not know at this point whether that is good or bad, but we have had a 4.8 million pound increase in working capital. Now comes the fun. We're going to do some numbers with this. So we go back to our profit and loss. What we need to figure out is, can this business generate cash? So that's what we essentially describe operating cash flow as, the ability of a business to generate cash. So in order to do that, we need to take the net income off the bottom of the P&L. We add back in depreciation. The reason that we add back in depreciation is a non-cash expense. Everything else on the P&L up to now is a cash expense. You have to pay for your interest. You have to pay your business taxes. But depreciation was a non-cash expense. It's nominal in these calculations, but that's why we add depreciation back in. And then we bring back in our change in working capital. How much the working capital grew from one period to another, not the total amount of working capital we have, but the change. Triangle is mathematical symbol for change, just so you keep up. So let's do the numbers. We take our net income, 4.3 from the bottom of the P&L. Our depreciation, small number, 200,000. We bring that back in, and our 4.8 million change in working capital. We have a problem. We've answered the question if Joyful Books is able to generate cash. The ink is red. The answer is no. We have a negative number. We're at negative 227,000. Our operating cash flow is negative. So we've used debt. We have not generated cash. Now we go from operating cash flow. Operating cash flow is a critical measure for your management team. Now, profit is pretty important for your management team, but the question is do you make your management responsible for profit? And to take that one step further, do you make your management responsible for working capital? These are under management control. If they're not under management control, then they're quite possibly under nobody's control, and that's not a good picture. Now, that might mean that you have to understand it better. It might mean that they need access to more information so that they can understand it better. But all of the levers involved in the sums that we've done so far are under management control. The goods you're selling, the price you sell them at, the costs that go into producing that and selling that, the other expenses in the business, whether people are paying their debts on time, whether you're buying or selling stock and how you're managing your stock. All of these things, all of the variables in the numbers we've come through so far, somebody is controlling them in your business. If it's only you, then you're probably not getting much sleep. But that should be under management control. And management should be equally responsible, not just for profit, but also for the working capital side of the balance sheet as well. Many of you will not have stock, but if you are giving credit to your customers, then you have debtors, you have accounts receivable, you have working capital. Some of you will be lucky, you have service businesses, you get paid up front, it's like no working capital and you're just selling air, fantastic. But this is Joyful Books. We have working capital. We've got stock. Okay, so Joyful Books has a blind spot. We know they're focused on revenue and profit. The profit and loss looks amazing. And gross profit line was up 33%, but clearly Joyful Books does not understand cash because they are burning cash. And operating cash flow is our first cash flow measure that helps management and you to bridge this gap. There are 7 levers that are going to affect operating cash flow. Inventory, receivables, and payables will specifically be levers that affect your working capital. All 7, the other 4 will affect the profit and loss and affect working capital and affect the balance sheet. Your management team needs to understand this. And you need to understand this, especially if you've got working capital, and understand what any one change in any one of these variables, how that will impact future cash flows. We call that modeling. You can do that. You can do that with a spreadsheet. Actually, ChatGPT can do that for you with a spreadsheet, but you still have to know the questions to ask ChatGPT. And that's the issue where we haven't quite got to yet with AI. You need to know what questions to ask. So let's see what the missed opportunity was with Joyful Books. So we're going to make a simple model here of what the revenue increase was from 2022 to 2023. I haven't edited that slide. I believe on your page it's 23 to 24, but no bother. So we know that we had a 25% increase from 28 million to 35. So we can model that we should see 25% changes across the board if nothing changes with efficiency. We might want to beat that in other areas. But we would certainly take 25% as a baseline for our forecast. So if we look at our gross profit and we scale up 25%, we should have been at 15 million. Actually, Joyful Books outperformed that. We made a 1 million gain. So if we'd have kept at 25% performance at the GP line, actually we've outperformed that by 1 million. A fantastic start. However, look at our expenses. If we take a 25% increase on what our expenses would have been, actually there's been management wastage here. And I do put that responsibility squarely on management. Somebody's deciding what we spend money on. Again, I hope it's not only you. Management has wasted £625,000 based on my forecasting forwards, this 25%. Accounts receivable, eek, it's horrendous. If we'd have had a 25% increase in our accounts receivable, then we'd have been at 7.1 million. Management have wasted 1.5 million. Stock and inventory, again, if we scale that up by 25%, we've wasted 550,000. Accounts payable, a small gain of 50,000. Netting it all up, management have gained 1 million by a focus on revenue and profit, but they have wasted 2.75 million on the balance sheet. Netting it all up, the management team of Joyful Books has negatively impacted the cash flow of this business by negative 1.7 million. We're modeling. This is what we're doing. That's how it should have looked, and this is how it ended up looking. And we could have looked at that at any number of points in time throughout the year, presumably, as we repeated our models and looked at where we could be more efficient. You might have actually wanted more than what was in this column, but that as a baseline is what we would have expected. So let's take our operating cash flow figure. So we already had operating cash flow figured. We know that this business doesn't generate cash. It's at negative 227. It could have been, in fact, it should have been 1.47 if we hadn't have lost this 1.7 million. But it doesn't matter. We'll get onto it. Now we need to figure out how much cash this business has for expansion. The answer is it doesn't have any, but we'll do the maths anyway. In order to figure out how much cash we have for expansion, we take our operating cash flow and we subtract any capital expenditures. So we'll do the numbers quickly. We'll bring up our operating cash flow figure, subtract our capital expenditures. It's hidden on the sheet in front of you. Don't worry about where I've taken that from. But the business in this example increased their assets by 200,000. So we're assuming capital expenditure of 200,000. And our free cash flow is going further into the red. Should we have been spending that money on capital expenditure? Maybe, maybe not. We need to decide that as well. So we have negative free cash flow. We do not have money to invest and build this business. This business is burning cash. Now, free cash flow is a critical measure for scaling, and it's a critical measure for scaling because scaling is expensive. You need to spend money on stuff. And if you don't buy stock like Joyful Books, then you most certainly spend money on people. And more money will mean better people and be faster scaling. You need to spend money on infrastructure, whether that infrastructure is physical, digital, virtual, or whatever it is. Businesses require stuff, and you need to spend money on that. You need to hire smart, intelligent people in order to do that. And if your free cash flow is negative, then you have to get that money from somewhere else, or you have to cut back. In 2020, I had to cut back. I don't think debt would have been a way of necessarily getting out of a scenario of having zero sales. But many businesses will carry debt unnecessarily to take them through mismanagement of profits and working capital. But if you have positive free cash flow, then that means the business can self-fund its growth and doesn't have to take on debt, or can reduce its debt burden. Again, there is no jury here on whether debt is good or bad. But if you're using debt simply because the business is not being run efficiently, then I think we can agree that that is bad. So we'll come back to our 3 cash flow measures, and I've patched in the numbers. Our operating cash flow, the whole picture is red everywhere. We've got negative operating cash flow. We subtract our capital expenditure, then we've got negative free cash flow. And if we look at the net cash flow of the business, the total movement of inflows and outflows is negative 2.4 million. The business is burning cash. It's growing, but to coin a term, it's growing broke. Now what we want to do is we want to take our profits and working capital and we want to bring those back and we want to put them side by side, because clearly this business has a mismanagement of working capital issue. So if we take our net profits from the previous year and look at the change versus the change in working capital, we know that our working capital is growing faster than our net profit. Working capital is sucking cash where net profit is generating it. So we've seen a 31% growth in our net profit and a 44% growth in working capital. We already know this. We already know this is bad. What you can do is you can chart these. You can put them on a chart and decide what is the direction of travel. What is the direction of travel today? What is the corrective direction of travel that we need to go in? There is no real purpose in growing a business in direction C where these grow in tandem, because what you get is a bigger business that will keep you up more nights but doesn't generate any more cash. It doesn't make any sense. And in this scenario, in fact, the business is far worse than that. It's going somewhere between C and D, because working capital is growing faster than net profit. Between C and D is growing broke. Between D and E is clearly going off a cliff. Rather, focus on direction B, or somewhere between B and C. You want to increase your net profits faster than you increase your working capital. And in a corrective scenario, you may need to actually go more in the direction of travel somewhere even further back than that, towards A, where you are slashing working capital, making corrective actions while still hopefully growing your profits. And whose job is it? It's your job. Growing between B and C is the job of the CEO, and it's the job of management. It's not anyone else's job. And once you've got an awareness of it, you can model it and you can take corrective action. Now, continuing this theme of looking at these two things, it's like mixing the two types of blood. You should never do it. We're taking numbers from the profit and loss and from the balance sheet. So we're comparing profits with working capital. We can project how much revenue, how much cash specifically, growth will achieve. And this is called marginal cash flow. Marginal cash flow is about the ratio between the change in working capital and your gross profit. It can help you forecast how much cash growth will achieve, how much your working capital machine, how much your business machine, how much cash it can output as you grow. And it allows you to model the cash impact of every £1, $1, 1 penny of growth. Now, there is an assumption here that this works more so for working capital businesses and that businesses that have some cost of sales. If you're in a business that's purely service business and your gross profit line is at 95, somewhere between 95 and 100%, then this particular ratio is not going to be very interesting for you. But for businesses that have a gross margin lower than 90% and that have some working capital, then we can see how much our working capital machine, how much cash is going to come out of that as we put growth into the machine. So let's do this for Joyful Books. So we already know our figures. We've got our revenue and our gross profit. Now, what is our gross profit percentage? It's 45.7%. I'm representing it here as a decimal because 45.7% isn't just a percent. It's 45 pence out of every pound. So every pound of revenue that traveled through Joyful Books, 45.7 pence of that was retained at the gross profit line. Now we have a working capital, which is a bit of a disaster at Joyful Books. We add that up, the total sum of all our working capital is 15.7 million. Look at how close 15.7 million is to our gross profit line. If we divide that working capital back up into our revenue, it's 44.9%, or 44.9 pence for every pound. We are using up 44 pence in working capital, and yet we are only generating 45 pence in gross profit, and we haven't even come to the expenses of this business. But this allows us to model what growth will do, assuming that management remain as inefficient as they are, assuming that we do not yet have control over those 7 levers, which hopefully you do. What will growth do in this business? If we take the gross profit and subtract from it the working capital, we're sitting at, call it 1 penny. which means that for every £1 of revenue, you generate 1 pence of cash. That's not a great business to be in. Remember, you haven't yet paid for your expenses. That means that if you generated £1 million in extra revenue, that's only £8,600 in cash. Now, the previous year, this is modeling, the previous year, the marginal cash flow was 4 pence in every pound. That's still a disaster, but look at the direction of travel. And this is the important thing with modeling. You have to go back in periods, quite often years, with some of these big numbers and see what the direction of travel is. And you have to go forwards. Usually it's best to go forwards 1 quarter at a time. For small businesses, quarterly, because sometimes revenue is a bit lumpy, etc., etc. Of course, you can do any of these numbers at any point in time, should you wish to. So this business is not generating cash as it grows, or certainly not generating sufficient cash. So, some next steps for you. Number 1, get your house in order. I know from some conversations that not all entrepreneurs have their accounts in perfect working order. They're not always up to date. They're not always done in a timely fashion. We don't always know what the numbers mean. We rely sometimes on external people to tidy and complete and shape those numbers for us, and we're just happy to sign the end of year document. Get your house in order. In 2020, I told you I made a big decision. It was because of the power of my financial models. But if I took you back 3 years before that, I barely understood my profit and loss. I had some problems before that, and I realized that I needed to educate myself in this, and I decided to do so. You are all smart people. None of this is beyond you. It's about having the appetite and interest and deciding that it's important enough. I encourage you to not think of this as something that's, I don't like dealing with the numbers. Some of you will be numbers people and some of you won't. It is absolutely not beyond any of you. And it's certainly not beyond you to find somebody else that can understand it and pay them good money and get the information out of them for it. So the first thing is to get your house in order. Then I want you to go backwards annually. And you can go forwards quarterly. And what you should do when you do that is add the story. There's always a story. We don't know the story with Joyful Books. We don't know if they were making specific investments, if they had specific issues, if they had, maybe they lost a customer, gained a customer, maybe that increase in debtors, accounts receivable was because they had one bad customer not pay. We don't know what the story is. Add the story. It's important not just to give the numbers more meaning, but because we all have terrible memories. And when you look back and you think, hey, that was a really good year. Why was that a good year? You can realize that, oh yeah, we fluked that customer, or whatever the circumstances, but we got that really cheap debt, or whatever the story is. Add the story. What were the business decisions you made in that year? We launched that product that year. And when you look back at that, even 1 year from now, but certainly when you look back in a few years, that story will be illuminating. So go back and add the story. Model every forecast in terms of cash flow. I presume that some of you will already do forecasting for revenue. You'll draw a line. You go, ooh, we're going to 10x this year, or we're going to double, or we're going to this, and then everything else just follows. You'll do some sort of modeling, even in your head, I'm sure. But always include in your modeling cash flow. Cash flow is the most important determinant of the long-term value of your business. Do not just relentlessly focus on revenue. Model cash flow when you do your modeling. And what we do when we're doing this modeling, we call it sensitivity modeling. We play with our risks. Remember, we can't predict risks. That's based on the quality of your assumptions, but we can put risks into the model and project them. And that's exactly what I did in 2020. I took a basis assumption of things getting a little bit worse and a little bit worse and a little bit worse. They got a lot worse. And what that would look like, and I figured I would go broke by April. Actually, I would have gone broke sooner. It would have gone faster than I thought it did. But nonetheless, the modeling allowed me to make those big decisions, and that's what I want for you to be able to do. Do sensitivity modeling. Okay, now everybody is perfectly able to go home and do their financial modeling and their 3 or 4 measures of cash flow. We're going to move on to labor efficiency. How are we doing for time? Woo-hoo, okay, we're going to move quickly. Okay. In order to understand labor efficiency, we first have to understand a simple concept, which is unit economics. Unit economics is about understanding the profitability of a single unit of sale. I'm glad we have Joyful Books, because a single unit of sale is a book. How profitable is it to sell a single book? Could be, how profitable is it to sell a single hour of your time? But whatever that unit is, it's about understanding the profitability per unit. And it's very useful for modeling growth. So when we model growth, we often look at unit economics. Now, the key metric for this is contribution margin. Contribution margin is about essentially how much you can make per unit versus the cost for that unit. So if we take a very simple example, digital marketing agency is charging $3,000 per month per client. We have variable costs, and I'll come to a definition of that term in a moment. We have variable costs of 1,000. We've got simple maths. The contribution margin is 2,000. And the reason that we get the contribution margin for understanding unit economics is we want to figure out a break-even analysis. This is Unit Economics 101. And I'll show you how it's relevant in a moment. So to do a break-even analysis, we look at our fixed costs. And in this example, we've got 50,000. We switched from dollars to pounds if you're paying attention. So the break-even is our fixed cost divided by our contribution margin. So we now know that we need 25 clients per month. This is a basic financial model using unit economics. It's a bit like building up our little collection on a Monopoly board. So our variable costs increase as sales grow. Our fixed costs hopefully stay the same. And a business with more variable costs is usually considered easier to scale, although it might have lower margins involved for us. High fixed costs perhaps represents higher risks, and we might consider that we need to scale carefully. And then here's a whole chart of things that get involved in both variable and fixed costs. But we have an issue. Most of us, our biggest expense, actually all of us, our biggest expense is people. And people do lots of different things, and I haven't tried it, but it's very, very difficult to divide a person, to decide how can you split that person between variable and fixed costs? How do you break down the unit economics of a person? Some businesses do it where they're purely time-based businesses and it's all done on time tracking and then they're focused on utilization. But generally it is very hard. So the normal way that we model contribution margin and break-even analysis and unit economics doesn't work for most businesses anymore. And that's where labor efficiency comes in, by looking at our total labor cost. Our labor efficiency is a variable output cost. I'll work it backwards. People are a cost. How much they produce is variable. No two people are the same, even if you pay them the same. And it is based on their output, what they're able to produce. It is under management control. It is impacted by the skill of your management. That's why you have management. Better management will be more productive people. And it is the number one driver of profitability in your business. How effective your people are. We've all experienced a great person and a loser. And that's what we're measuring. We're measuring it by looking at the numbers on our profit and loss. So, labor efficiency ratio. It will tell you how much money your team can generate. That's only partly true. What it's actually telling you is the most they have ever generated in the past. It doesn't tell you about their actual potential. So there is always the possibility that you could push a little harder on the accelerator. You've got to decide that. But it is telling you how much they have generated at their peak at any point in the past. That higher watermark is very important to know. It's telling you how well they're performing today, because if you know what that high watermark is, then you know whether we're at that high watermark, pushing up against it, or whether we're actually 20% below where we're able to perform in the past. And it will then help you decide when is the right time to hire. And that can be quite a tricky decision for people. Now, obviously, sometimes we put investment and we put money into growing our business. We want to hire people in advance of using their capacity. But frequently we're involved in decisions where somebody says, oh, we're very busy. We need extra engineers. We need. How do you make the decision? You don't always know if that team is maxing out, but labor efficiency ratio will tell you if that team is maxing out. Now, there are two ways to do labor efficiency, the lazy way and the way that we're going to show you to do it today. So the lazy way is where you simply take your revenue, you divide it by the number of employees, and now you have how much revenue each employee is able to generate. It's a quick and dirty way of comparing large businesses where you've got access to that data, because any business that's audited, any public company publishes their revenue figure, you know how many employees they've got, and you can see that Goldman Sachs has a higher revenue per employee than Merrill Lynch. Fantastic. But what we want to really understand is efficiency per pound, per dollar, per penny of money spent. So what we do is we sub out these figures, we bring ourselves down to the gross profit line. Gross profit line is really the real revenue of any business. So we take out the distortion of different types of business that have radically different gross margins. We take out the cost of sales. Your labor is not responsible for everything below gross margin. Some of them will, management, but they're certainly responsible for the effectiveness of everything above it. So we go in at the gross profit line and we take labor as a cost, dollar, pound, penny, etc. And this is how we get to labor efficiency ratio. So I'm going to do super simple numbers. So we've got a company with revenue of 5 million. We've got cost of goods sold or cost of sales, depending on your type of business, of 3 million. So we've got gross profit here of 2 million. And the labor is 1 million. So we simply want to divide our labor back into our gross profit. 2 million divided by 1 million is, check everybody's awake, 2. It's 2. It's 2, but it's not just 2. It's got a pound sign on it. It's 2 pounds. And what this is specifically telling us is that for every 1 pound you spend on labor, you get 2 pounds back. That is your machine. Your job as a CEO is to figure out where you are today, where you want to get to. Then looking at that gap, figure out what the obstacle is in that gap. The obstacle is always in the gap. And then you have to build the machine to clear that obstacle. And the biggest part of the machine, the biggest cost in that machine is your people, for all of you. And in this machine, we spend 1 pound and we get 2 pounds back. Therefore, when we do our modeling, I will expect that I always get 2 pounds back or more, but certainly not less. Again, you can go backwards and forwards with this. Now, has anybody heard of the author Greg Crabtree, wrote the book Simple Numbers? Yeah. Multiple people in the room. Fantastic guy. CPA, Chartered Public Accountant in America, wrote the book Simple Numbers, did some great work on labor efficiency ratio as well. And he kindly put together a montage of all of the accounts of all of his customers over a certain period of time and divided them into 3 categories. Companies that make stuff, so companies that buy in a raw material and manufacture. Companies that sell stuff, so companies that sell a finished good and then sell that, and companies that do stuff, service companies, sell air, or services, etc., etc. Now, what I've done in this table, slightly different from Greg's book, with his permission, is that I've normalized their data to the gross profit line, because I wanted to show that despite differences, he has different customers in different industries, all sorts of different sizes, but despite that, if you normalize to the gross profit line and you see how different the gross margin is per 1 million spent on gross profit, or sorry, per 1 million achieved at gross profit, there's not a wild amount of difference in the amount spent on labor. There would be if we took their original revenue numbers and I hadn't normalized these figures, if you follow. But the amount spent on labor per gross margin is actually quite similar. And there we've got labor efficiency ratios for those different types of business. So it gives you a sense of what some actual numbers in real businesses averaged out look like. So it's highest for businesses that sell stuff, and it's lowest actually for service businesses that do stuff. This changes as businesses scale to mega kind of valuations, because you've got businesses that are selling IP that's only cost a certain amount to make, and if you're selling, Google search or whatever, then eventually that goes astronomical. But for medium-sized businesses, which is Greg's sweet spot and more applicable to this room, these numbers are pretty typical. So it gives you an idea of a baseline. Now, you can divide your labor up. I wouldn't suggest that you do it unless you have 20 to 25 people as a minimum, but you can go one step further and say, well, not all labor is the same. We have direct labor, which is anybody that is directly involved in making or delivering your service or product. So they spend most of their time delivering or making. Traditionally, it would have literally been people in a factory, but now it's generally people delivering a product. So they're facing the customer, and that's what's producing the value for the customer. You've got sales labor, which is people that are full-time engaged in sales. You can see why this generally needs to be slightly larger companies. And then management labor is simply everybody else, because management is not just people we call management, it's the support layer that is not directly generating revenue by servicing a customer or by selling to the customer in a business. Now, direct labor's responsibility is to drive the performance of your gross margin. Sales labor, of course, are all about driving revenue and hopefully profitable revenue as well. And your management labor are there to manage both the direct labor, manage the whole P&L, manage the whole business, and manage cost of goods and the balance sheet and everything else as well. And what we can do in a business is that we can then scale up. We can measure this individually and see how much we should be spending per pound and what we should get back per pound spent on sales people, which is a figure that most of us would actually like to know when you really sort of think about it. I should spend £1 on salespeople and get £2 back, or whatever that metric should be. Figuring that out can be very, very useful as you scale your business, as can knowing how much you should spend in management as well, which over time will become a little bit more efficient. And obviously direct labor is servicing your customers. You want to know how much you need to spend there as well. Some guidance notes for direct labor. Exactly the same as we were talking about with all the cash flow. Measure it regularly. Go backwards annually, or even go backwards quarterly, and then go forwards quarterly. Figure out what good looks like. Again, add the story. Oh, we had a really good ratio back then. We had those really excellent staff, or we were running very lean then, or we didn't have this cost, or the situation was different. The business has maybe shifted. Add the story. Figure out what that story is. Then once you know your labor efficiency ratio, you can figure out where it is, particularly when you're most profitable. And also you can look at how it reflects your free cash flow as well. Where does it sit under different scenarios? Does it take a while to catch up? Do you put extra money into labor, lowering the efficiency ratio, and then you see a return on that in 1 to 2 quarters, for example? This is all modeling. Treat it like a world record. It's your high watermark, but it exists to be beaten. It is the efficiency, it is the productivity of your people, and it exists to be beaten. Now, that doesn't mean that you bring down your labor cost as much as possible so that you can get a good labor efficiency and none of your customers are being serviced. Again, you have to add reality and you have to add your story to it. But when you know that things are running well, you want to know what that looks like per pound of gross profit. Per pound of gross profit. Finally, build up profitability with your existing team before adding more. Use it as a little cycle. You can see a team is getting more productive, and now you think it's a time to add people. It will drop. You've added expense. Build it back up again, and then you think it's a time to add people. Watch that cycle and learn that cycle. Okay. We're doing pretty well. I think I've got one more slide, which I said I would touch very briefly, and finally on funding. This is not a talk about funding, but I wanted to touch on it because, of course, we've talked about some of the mechanics of debt and equity, and these are decisions that many of you will make on a day-to-day basis. So I want to give you 3 ways to fund your scaling. And the first is this whole free cash flow thing, is making it self-funded. Generate as much cash as possible from your internal operations. Obsess over your expenses and obsess over your free cash flow, not just your revenue. Generate free cash flow, and that is the first source that we should all address for scaling. It has some clear upsides. Sometimes, however, we might need more cash for scaling, and so it may be limited. It may or may not in your situation, but it may potentially be limited, and that's why we may seek other sources. The first of those being debt. Obviously, debt means that we have the interest burden of that debt. The critical thing with debt is to model the impact of that debt on growth. That's why you took on the debt, hopefully. Not just to get you out of a hole, but if you did, okay. You want to model, you want to forecast in advance exactly what you expect to achieve in growth terms from any debt you take on, and then of course you can continue to model that and see if you're keeping track. There is nothing wrong with debt if it is effectively growing the business at a lower burden than the debt interest. Hey, why not let somebody else pay for your growth? So long as you're not growing broke, so long as you haven't got negative cash flow. And finally, in some instances, where it is applicable to certain sectors, and we won't go into depth in it, equity financing, giving up control, going out to outside investors, angels, etc., selling off shares is obviously an option, and it's very applicable to some sectors. It's a little beyond the scope of what we're going to go into today. But the first one, free cash flow. Having strong free cash flow is the number one determinant of long-term value of any business. You can definitely scale faster with debt. It is, in fact, in many instances, a great idea to scale faster with debt, but you've got to understand what you're doing with that debt. And obviously, clearly, with equity financing, there is probably higher risk on the table, and that's why you want to take equity. You're sharing that risk. If you've got high risk and want to share that risk, that's not a bad way to access funds either. I'll bring us back to our analogy before closing. Your goal is not to build the longest train. Your goal is to reach the station first with the most fuel left in the tank. And let's all go have a beer.